CNBC recently reported that 63% of Americans can't cover a $500 emergency, which highlights a serious issue that shows financial education is lacking. Schools rarely teach money management, and many parents can't pass on financial knowledge because they lack it themselves. To make matters worse, discussing money openly is still taboo for many. This is unfortunate because building wealth is simpler than it seems once you understand the basics. In fact, studies show 80% of millionaires come from middle or lower income families. With the right approach, anyone can grow $100 into $1,000, $10,000, and eventually $1 million. Here's a step-by-step blueprint for achieving wealth, identifying the best risk-adjusted returns. I believe in practicing what I preach, so let's get back to basics. No matter your job or income, managing cash effectively is key. Most people don't know how much they spend or where their money goes. They simply rely on their bank balance or credit limit. When funds run low, they cut back until the next paycheck, creating a never-ending cycle. Wealthy individuals, however, take a different approach. To build wealth, start by tracking your expenses for 60 days using tools like RocketMoney, YouNeedABudget, EveryDollar, MonarchMoney, or even an Excel sheet. Record every cent coming in and going out. This will reveal if you're overspending on non-essentials, making impulsive buys, or overpaying in areas where you could save. Once you're aware, you can adjust and potentially cut expenses by 10 to 15%, like a diet. Understanding the details is the first step to optimizing your finances. Now is the best time in 20 years to grow your money, thanks to high-yield savings accounts offering at least 4%, with some reaching 5% or more. For example, Ally Bank offers 4.2% with no fees, while Wealthfront and Robinhood Gold provide 5%. If you can set money aside longer, Treasury money market funds like Vanguard's VUSXX or Schwab's SWVXX are paying over 5%. Ensuring financial security regardless of fluctuations in income, the economy, or investments, all while earning a solid return. Once you've built a cash cushion, the next step is tackling high-interest debt, which has become a growing issue. The average American owes over $22,000 mainly from credit cards, car loans, and personal loans. At today's interest rates, failing to pay down debt can cost you thousands annually. Here's my approach: if the debt's interest rate is higher than the return I can safely earn from investments, I pay it off immediately. If it's lower, I pay it off slowly and invest the difference. Ask yourself, can I get a risk-free, guaranteed higher return elsewhere? If not, focus on paying off the debt. To do so, you can choose between two methods. Avalanche Method: pay off the highest interest debt first, then move to the next, saving the most money over time. Snowball Method: pay off the smallest balances first for quick wins and motivation, regardless of interest rates. Both strategies are effective, just choose one and commit to it. The third and arguably most important step in investing, especially for beginners, is opening a Roth IRA. This account allows you to contribute up to $7,000 annually, and by the time you're 59 and a half, all profits are tax-free. And even better, you can withdraw your contributions anytime without penalties. If you earn under $161,000 annually as a single filer, a Roth IRA is one of the most efficient wealth-building tools. For example, if you start at 20, max out $7,000 each year, and earn an average 8% return, you'd retire at 65 with over $3.1 million, owing nothing in taxes. Starting young is ideal since you're likely in a low tax bracket and have decades for compound interest to work. Opening a Roth IRA is easy and can be done through any major brokerage in just 10 to 20 minutes. When it comes to investing, diversify, spread your investments across various companies, sectors, and asset classes to minimize risk. For instance, tech stocks dropped 78% during the dot-com bubble, housing prices fell 50 to 70% during the crash, and cryptocurrencies have seen declines of up to 99%. Diversification is your safety net. Don't try to beat the market. The vast majority of people, including professionals, fail to outperform the market consistently. Instead, focus on riding the market's overall growth. Stick to index funds. Warren Buffett has called these the best investment for most people. Index funds offer broad diversification, low costs, and exposure to a variety of industries, making them simple yet effective for long-term growth. This disciplined approach avoids the pitfalls of get-rich-quick schemes and sets you up for sustainable wealth building. Fidelity, for example, offers no-fee index funds that cover virtually everything you'd want to invest in. Finally, the key to success is to dollar-cost average and remain patient for the long term. This step is often the hardest because even if you do everything else right, panic selling during market downturns or hesitating to invest during dips can lead to missed opportunities. For example, if you sold during March 2020, expecting further declines, you'd still be waiting to re-enter, or if you sold at a peak, only to see the market climb higher, you'd have missed out. Studies consistently show that a buy-and-hold approach with a well-diversified portfolio outperforms other strategies over time. Historically, the S&P 500 has delivered an average annual return of 10.6%, with dividends reinvested over the last 100 years and 13.4% over the past 14 years. However, future returns aren't guaranteed and depend on two factors. When you start investing, timing can impact short-term results. How long you invest, the longer you stay invested, the more you smooth out market volatility. Patience and consistency are your biggest allies in building wealth. From March 2000 to March 2009, the S&P 500 returned -5% annually, coinciding with the dot-com bubble peak and the Great Recession. In contrast, investing from 1978 to 2000 yielded a 17.4% annual return. Historically, 20-year rolling returns have always been positive, but annual returns have ranged from 2% to 18%. Future performance could differ significantly. A study explored whether the market could replicate the past decade's 12.8% annualized returns, which were exceptional, ranking above the 90th percentile since 1950. This success was fueled by low interest rates, which pushed investors into markets, and strong earnings growth. However, with interest rates now near multi-decade highs, for similar returns, the price-to-earnings ratio would need to double, nearly 40% higher than the tech bubble peak, or earnings growth would need to hit an unlikely 6% annually, one of the best outcomes historically in non-recessionary times. Simply put, such exceptional returns aren't likely to continue. Vanguard projects U.S. equity returns of 4.2 to 6.2% annually over the next decade, while Charles Schwab predicts about 6% annualized growth for large-cap U.S. stocks. These tempered expectations highlight the need for realistic planning. Earning 12 to 15% annually in the stock market is not sustainable long-term and shouldn't be expected. Historically, average returns have been closer to 7 to 8%, which is a more realistic benchmark for the next 20 to 40 years. The goal is to spread investments across uncorrelated assets so gains in one area can offset losses in another. Having cash on hand also allows to buy during market dips. Ultimately, building long-term wealth comes down to these fundamentals. Optimize your income and expenses, pay off high-interest debt, maximize tax-advantaged retirement accounts, diversify your portfolio, stay consistent. This approach may not sound as exciting as making $1 million a month from dropshipping, but it's realistic and builds a strong financial foundation. These strategies are timeless. You can revisit them years from now, and they'll remain relevant. Finally, if you enjoyed this content, don't forget to like, comment, and subscribe to support the channel. Thanks for watching, and see you next time.